The CPI year on year coming in 2.2%, bang in line with estimates and higher sequentially from January's print. If you back out food, you back out energy on a month-to-month basis, that comes in up 0.2%. On the year-on-year level, coming in 1.8%. So it's a story of a steady inflation picture. And if you take a look at what we're seeing in the market, that's a busy screen, but we're seeing S&P futures spike to the highs of the session. Dollar index goes nowhere. I can't yet see really the move in the Treasury market. I'm going to bring it up on my screen here to check it out for you. Basically, not a lot of action coming in for the Treasury market. Yes, you're seeing the yields move off the lows of the session, but the move seems to be in the equity market as we see a stronger inflation print. David.
Okay, we're going to bring in two people now who can really help us go into all this. They're experts. Steve Ricchiuto, he's Mizuho chief U.S. economist, and Luke Kawa from Bloomberg Cross Asset. So, Steve, what do you make of this? It's sort of like, nothing's going on here. You can move along.
It's a bit return to Goldilocks for the equity market, which is why you're seeing the market behavior as it is. It takes a little bit of the pressure off the Federal Reserve to move from 3 to 4 on the projected rate hikes at the upcoming March FOMC meeting. And that in itself is a positive environment for equities, because equities had discounted 3. They weren't discounting 4. And with it kind of looking like that becomes less of a probability, the equity market will do well and the bond market will do nothing. This is a repeat of the payroll employment numbers last Friday.
Luke?
More or less, and if we're trying to look for a reason or an excuse why maybe yields don't sell off, we're not getting a rise in yields rather on higher inflation and a pickup and a lack of give back. Think of positioning going into this, like euro dollar duration equivalent all the way out. Positioning is very extreme, short treasuries. So the kind of oomph we've got, the last 2 inflation reports have been in synchronicity, complete. You get the yields rise, SPOOs selling off. It just seems like we're not positioned that we can do that even with a pickup of inflation.